Okay, so we're going to get started here. This is Buck Joffrey. Looking at the list, I know most of you from Wealth Formula Podcast and through my investor group. But I just want to do a quick intro and for those of you who are new to our events, and then introduce you to today's speaker. So just about me. So, again, I'm Buck Joffrey. I am a surgeon by training. I turned into a serial entrepreneur and investor after that. I'm an author. I wrote a book called 7 Secrets of Eternal Wealth, which was a #1 Amazon seller. And also, I am the host of Wealth Formula Podcast. So, again, for those of you who have not heard my podcast, please tune in. You'll love it if you like this kind of stuff. And you can get on iTunes, Stitcher, etc. You can find me on wealthformula.com as well. And basically, we're just focused on wealth building for high-paid professionals outside of Wall Street, which obviously includes wealth of saving money too, like taxes, right? So, I always tell people on my podcast and also in my investor group, not what you make, but it's what you keep. And taxes are your probably, if you're most people, they're your biggest expense. And unfortunately, though, most people just focus on what they make and they try to make more and more money, which is great. But the wealthy focus on not only what they make, but also what they keep. And it's kind of like the version of profit with a business. They worry about the top line and the bottom line, and the middle is profit. So that's where taxes fit in. And the majority of people don't even try to mitigate taxes at all. So anyway, I actually, sorry about that, slide kind of got away from me. I actually didn't know that there was much you could do about taxes myself until I read a book called Tax-Free Wealth from a guy by the name of Tom Wheelwright. And ultimately that led me to engage with Tom's firm, which is Provision. And that was a few years back, and they literally saved me, I can tell you, millions of dollars in taxes legally since then. And one of the guys I worked with there was Tim Gertz, and Tim is going to do a talk for us today. And Dave Zook, obviously there are some of you out there from Dave's list, and Dave is a friend of mine. He's the real asset investor for those of you who don't know. And Dave has also worked with Provision. And so we thought it'd be a great idea to share how Tim and really a number of people at Provision have helped us save as much money as they have and try to spread the word. And so Tim's kindly offered to give us a talk today that couldn't be more timely, because there's still a little bit of time to do some of these things that can save you a bundle of cash. So without further ado, I'd like to introduce Tim Gertz from Provision, and he's going to do a talk called 5 Ninja Strategies to Reduce Your Taxes in 2017. Tim.
Thanks, Buck. So as Buck said, my name is Tim Gertz. I'm a partner at Provision. We're a firm focused on tax planning, proactive tax planning. So really looking at what we can do for our clients to be proactive in everything, in every facet of their life. So if it's investing, if it's business, whatever it is, making sure that they are forward thinking and really changing their facts to change their tax. And so what I wanted to talk about today was really wanted to discuss the 5 areas to look at, the 5 areas of tax savings, and make sure that we go over those, give a couple of examples. So, like I said, educate you so you can, as you're moving through your day-to-day life, whether it's investing, whether it's business, you're always thinking, and you always have in the back of your head this idea of, can I save taxes by doing this? Because ultimately, at the end of the day, to save taxes, you just have to change your facts. So everything is deductible. It doesn't matter what it is. There are very few things that are non-deductible, but in most cases, if it is an ordinary and necessary expense in your course of business, then it is deductible. And so as long as we can think about that and change our mindset to really start thinking, what can we do to make this deductible? Then we start taking expenses that ordinarily wouldn't be deductible and making them deductible, therefore driving down your taxes. So I'm going to go ahead and share my screen and hope this works. Okay, let's see. Perfect. So as I was saying, I wanted to really go over and explore the 5 areas of tax deductions and make sure that we've got a good understanding of what those 5 areas are, so that at the end of the day, as you are navigating your world, whatever it is, whether it's investing in real estate, whether it's investing in oil and gas, or running an operating business, you're always thinking about this, and you always have this idea in the back of your head and kind of going through the filter of, okay, does it qualify here? No. Okay, does it qualify here? What can we do to really put these things in these different areas to make sure that we are getting the most deductions possible? And so, as I said before, ultimately you have to change your facts to change your tax. And so we need to make sure and look at what we're doing and look at how we're operating and really look at, is there an opportunity to incorporate? By incorporate, we open up a huge arena of being able to really effectively tax ourselves as we feel fit and make sure that we have the best tax picture in place. Another opportunity is to invest, whether it is investing in business assets and using depreciation, investing in passive assets and using depreciation also. It really just depends on what our facts are and what we need and how we need to position ourselves to get the tax benefits that we need to offset the other income that we might have. Employ. If many of you are business owners or work in an operating business, you know that to employ people, it doesn't only give you the opportunity to deduct the cost of that employment, but it also leverages their abilities. So what you're doing in that is you're becoming more tax efficient, but you're also leveraging their abilities, their skills to grow your wealth. And so that's an extremely important thing to remember, not only in tax planning, but also in wealth generation is, leverage that through employees. Like I said before, making sure that if you have the opportunity to operate a business, then operate that business. The tax code is really geared towards business owners and investors. Everything is an incentive. There's very few code sections that actually are putting tax in place. All the other tax code really is opportunities and incentives for people to operate businesses and invest in the United States to grow the GDP and ultimately, make the United States the premier economy that it is currently. And then last, like I said, is just to make sure you're thinking. Always think about what you're doing. And that's one of the things that we preach at Provision is always being proactive and thinking and making sure that you're educated in what you're doing. So as you're moving through and you're looking at the different steps, you have a good understanding. And through that understanding, you're able to be proactive and say, you know what, maybe this will work. Maybe if I turn that Rubik's Cube this direction, I'll be able to make that match and I'll get that tax deduction. And so it's always being thoughtful in what you're doing and being proactive. And if that means reaching out, talking to your CPA, talking to your tax advisor, but making that phone call and being proactive and saying, hey, I think I'm going to do this. I think I'm going to buy this. I think I'm going to invest in this. What can I do? How can I position myself to get the tax advantages that are afforded to me so that I can, ultimately drive my tax down? So in tax planning, in proactive tax planning, our goals really are, we want to be tax efficient. By being tax efficient, by being structured properly, by taking the deductions that we deserve, we're minimizing our taxes. And by doing that, we're looking at what can we do to permanently reduce our taxes. Provision is all about permanent tax savings. We are much more, our goal is to look for permanent, not so much for deferral. So we tend to look at what can we do through the tax code to minimize things such as using 1031 exchanges, using credits, depreciation, estate taxes, things of that nature to really minimize your taxes throughout your life permanently so that you're generating that income. And so that's a very important thing to do in any tax planning, is to make sure to identify the permanent savings and not just shoot for the low-hanging fruit, the deferrals that, you know, ultimately at the end of the day might come back and bite you down the road when you retire, and now you're in a tax bracket where you take money out of 401k and you're getting hit at 50% tax. So it's really important in any proactive tax planning that when you're talking to your advisor, that you make sure that you are looking and identifying permanent tax savings first and foremost, and then at the end of the day, looking to see how can we utilize deferral. And what this does is ultimately it helps you achieve financial freedom, which then helps you build your wealth, which is, as Buck said, that's the most important thing, is to build your wealth, is to make sure that you are continually building your wealth. And by being tax efficient, by looking for these tax savings, these permanent tax savings, it gives you that ability to take that wealth generation to another level and ultimately take that money that would be going to the government, reinvesting it in yourself and achieving those goals a lot quicker than you would if you weren't doing proactive tax planning. So, like I said, there's really 5 methods, 5 areas to think about. The first one is deductions. So we'll go a little bit further into detail about these 5 in the next slide. So I just wanted to go over kind of the 5 areas first. We have deductions, we have eliminations, we have conversion, we have rate reduction, and then last but not least, we have deferrals. And like I said, we usually put that at the bottom because I like to get through those top 4 and then use deferrals if necessary, because there are some opportunities for deferral. So deductions. Thinking about deductions, these really are the things that you encounter on a day-to-day basis. These are things that you have in your operating world, whether it's a business, whether it's in your personal life. A perfect example to that would be, you know, in business, it's depreciation. So if you have a piece of equipment that you put in service, you know, you have a lot of opportunities on what you can do with depreciation. And depreciation is incredible in how it's set up because it gives you a lot of flexibility. And the way that the tax code is set up, you have options. And you know, when I talk about options, I talk about, you know, you have the option to be able to say, you know what, I want to elect to take all of this depreciation at one time. And if you do, you know, a lot of people you'll hear call it Section 179. It's the code section that deals with the, you know, the ability to automatically expense that asset immediately. You know, that's really good if you're in a situation where you have a lot of taxable income, a lot of active income, and you're looking to put assets in place and you want that immediate tax hit, you know, that tax savings, that's going to do it for you. You know, with depreciation, we have the opportunity to say, you know what, I want to slow it down. So you have the opportunity through the tax code to really say, you know, I don't need it right now. I really want to just spread it over the useful life of the asset. And the tax code allows you to do that. So depreciation is really a nifty little tool because it gives you the ability to take as much as you can up front or spread it over the useful life of the asset and everything in between. So it's a great planning tool. It's a great opportunity to really, like I said, to think and to structure yourself and to take these deductions when you need them so that you get the best benefit possible. The next deduction that a lot of people, you know, I hear a lot of times from clients, you know, my CPA says the home office is a red flag, or, you know, they won't let me take home office because they say I don't qualify. And, you know, a lot of times this is where we come to, you know, change your facts and you can change your tax. And so, you know, a perfect example would be a doctor. A doctor maybe works at a hospital, has an office at a hospital, or, you know, has private practice. But before they go to work, they review their day, they answer emails, they look at charts. They do that at home. And so by doing that at home, before they actually take that step out and go to the office or go to the hospital, you know, they are utilizing a piece of their house as an office. And by doing that, the IRS allows us to take that portion of business use as a deductible expense. And so a lot of times, as I say, you just have to change your facts to change your tax. We just have to think, okay, is there anything I can do at home? Do I have a dedicated office? Is it an area that I use regularly and exclusively for business? And if that's the case, then we have the ability to take that deduction. And so this too is, it's not going to break the bank. It's not going to be a number, hundreds of $1,000s of tax deductions. But even if it's $10,000 or $15,000, if you're in the highest tax bracket, I mean that's a $4,000 to $6,000 savings on your tax bill every single year by just thinking ahead of time, how can I situate myself to put myself in a position to get this home office? Same thing when we come to auto. A lot of times people they might have a home office and they use that home office and they deduct that home office, and then they get in their car and they drive to work every day and they work at their office, or they work at a offsite space or a hospital or something of that nature. And then they come home and they review charts or they do something, and then they end the day and they go spend time with their family. If that's the case and they're really utilizing that home office and that's their first stop of the day, their first and last stop of the day, and they can substantiate that that is something that they do ordinarily and regularly, then we have the ability to say, okay, well, any time from the time we leave our home office until we come home at night, that is a potential business deduction. So if you go from your home office to your office, that's auto mileage that's deductible. Then you take out, you go from your office to maybe a hospital or somewhere else, business expenses. You come home at the end of the night, that also is a business expense. And then as long as you come home, you utilize your home office, you have the ability to take that as a deduction. So once again, it's really thinking about what you're doing, changing your facts, and making sure that you're sitting down and structuring yourself in a way to get that deduction. Medical expenses are another huge one. It's making sure in most high net worth individuals, the idea of medical expenses is non-existent. Someone that's making $500,000 a year, they have to have $500,000 worth of expenses before they can even get $1 deduction for medical expenses. Sorry, did I say that right? $50,000 of expenses to get $1 of expense business deduction. And so ultimately, if we can look at how we're operating and we can look at what we're doing, and do we have an operating company? Do we have a management company? Do we have a marketing company? Do we have a company that we can ultimately utilize to take those medical expenses through and get the deduction? We're taking something that's not normally deductible and making it a deductible expense, because the IRS does give you the ability in certain circumstances to get 100% deduction of medical expenses. So we just really have to think about what we're doing, how we're structured, and make sure that we're structured properly so we can take those medical expenses. Even if it's once again, if it's $10,000 or $15,000, that's $10,000 or $15,000 that's not deductible, and that equates to another $4,000 or $6,000 a year of deduction. And this isn't a one-time deduction. This is a permanent tax savings. So this is something that happens every single year for you if you're structured properly. The last one, and this is an area where, if you do have a large operating organization and you have the opportunity, and this is something that takes a little bit more legwork, but the opportunity to use captive insurance, or what they call micro captive insurance, is ultimately the ability to use a company that is owned by the same shareholders of the operating company to deduct insurance costs and have those insurance costs be non-taxable to the corporation or the insurance company. And so we have an ability here where we can take a deduction for insurance, and this is usually a larger deduction than you would see typically in insurance, because it is a smaller pool that you're utilizing. So this is the opportunity to potentially take insurance premium deductions all the way up to $2.2 million a year and not pay tax on it. And you get the deduction at your ordinary income rates, and you ultimately end up not paying tax in the captive insurance until you pull that money out. And so from a timing standpoint, even if it was $1 million, that's $400,000 in tax savings a year. And if it's something that you're taking that money and reinvesting that money in other investments, in real estate, in other passive investments, whatever that is, then you're continually generating income on that tax-free income while it's inside the captive insurance company. And then when you do pull it out down the road, you're being taxed at capital gain rates. So, as long as you can structure it properly, you have the opportunity to get a 40% tax break and potentially down the road maybe pay 15%. And so that's a 25% arbitrage, or in a lot of cases, if it's $1 million, it's $250,000 of permanent tax savings. And that's things that you can do on an annual basis. So a captive insurance company is not a one-time thing. It's something that will continue in perpetuity until you decide you're no longer going to fund it. And so, that's a huge opportunity just in deductions to be able to look at things and see, what can I do? What can I do that I'm already doing, or what opportunities are out there above and beyond what I'm already doing that will give me those permanent tax savings? The next is elimination. So when I think about elimination, I think about, what can I do to just get rid of a certain tax altogether? What are we trying to do? And a lot of things, a lot of times you're positioned in a way that maybe you're not incorporated, or maybe you are incorporated through a limited liability company, but you have not made a tax election. And so through the use of an S corporation, we really have the ability to eliminate taxes. And what that means is not eliminate your ordinary taxes, but eliminate self-employment taxes. And so, as a perfect example, myself, a partner of Provision, I have employees that work for Provision and they generate revenue for me. If I was a sole proprietor and had those individuals underneath me, I would be paying self-employment tax, or 15.3% tax on their work. And so ultimately I would be, in a position where I would be taxed 15.3% on every dollar that they earned up to a certain level. And then after that point, it would still be 4%. And so I'm losing 4% on every dollar that someone earns for me for work that they're performing, not work I'm performing. And so what the IRS allows us to do is to elect to be an S corporation. And as long as we pay ourselves a reasonable salary for the work we perform, so work we do as an employee, then every other dollar that comes in is not subject to self-employment tax. So ultimately, we've eliminated tax. We've eliminated 4% per dollar, 4 cents per dollar of every dollar that is generated that doesn't pertain to your, to your work as an employee. So this is a very powerful tool. This is something that a lot of people don't look into utilizing. But it is something that can add up, especially as your dollar figures go up and up and up. And if you're making $1 million a year off of other people's efforts, that's a $40,000 tax savings. And that's something that, once again, is permanent. You've eliminated $40,000 in tax every single year. Another opportunity is a Roth IRA. So looking at what we can do to ultimately eliminate tax on your earnings. And so if you do have, a lot of times in today's day and age, people, are brain fed. There's a lot of brainwashing. Put into your retirement, put into your retirement, put into your retirement. That's the way you defer taxes. That's just what you do, is you put into a 401k or an IRA and hope it grows and grows and grows, and then pay tax on it when you take it out when you retire. Well, a lot of people have stopped doing that. And a lot of people have IRAs or 401ks that are just sitting around stagnant. They're earning income, but they are still pre-tax. And so if we can look at and do proactive planning and say, okay, in this year, perfect example, going back to depreciation, if we're in a situation where we have $500,000 worth of income in our company and we're going to make a large purchase, and we have the ability to drive our income down to zero, Now we're in a position where our taxable income is zero. If we at that time convert from a traditional IRA to a Roth IRA, we are taking a tax hit on that conversion at a much lower rate. And so, if it's $100,000, we're able to convert that. Yes, we're going to pay tax on it, and maybe we're going to pay $15,000 in tax on that conversion. But now we've eliminated the tax on that growth for the rest of the life of that plan. And so we've been able to minimize that tax and eliminate any tax in the future. Another opportunity is estate planning. So eliminations through estate planning, if that is coming up with a gifting strategy, having your children own your operating businesses, gifting shares of your operating business to your children. There's ways to eliminate taxes through estate planning simply by utilizing, taking it out of your tax picture and moving it into someone else's tax picture, and then eliminating the opportunity for it to be taxed later if you are above that estate cap. And so estate planning, I'm pretty short on estate planning on any description of it because it is such a robust thing, and it is something, but there are a lot of opportunities to eliminate tax through estate planning. And here are a couple through 1031 exchanges, buying assets and continuing to roll them through 1031 exchange or tax-free deferrals, and then ultimately get the step up in basis when you pass away and transfer that asset to your heirs. And if that's the case, you are taking the deductions through your lifetime for depreciation on that real estate. And when you pass away, the heirs get an immediate step up and they get to depreciate that asset again. And so if you bought that asset for $500,000 and fully depreciated, so got the tax benefit from that asset throughout your lifetime, and now it's worth $1 million and you pass away, that goes to your heirs. Now it's worth $1 million and they can start depreciating it again. So you never have to recapture that depreciation that you took throughout your life. Not only that, your heirs get a step up in basis and they get to depreciate that asset again. So that's one way to eliminate, and that is through the step up. The next idea is conversion. So when we talk about conversion, we think about what we can do to take our income from one bucket to the other. And so when we talk about buckets, there really are 3 buckets of income. You have ordinary income, which is one bucket. You have passive income, which is a second bucket. And then you have portfolio income, which is your third. And so active income is really W-2 wages, active trader business. Passive income is just that, investing in an ATM fund, investing in real estate, a syndication. Anything that you don't materially participate is passive. And then portfolio is just that. It's think about stocks and bonds. It's interest, dividends, and capital gains. And so what we want to look at is we want to look at how we can convert things from one characteristic to another to be able to utilize things that are in a different bucket. And so when you think about, one of the ways to think about it is if you have W-2 income and you invested in real estate and you have passive losses in real estate, you've got ordinary income in bucket A and you've got losses in bucket B. Well, unfortunately, they don't marry up to each other. And so you pay tax on the income in A and you don't get the deduction on B. And so ultimately what we want to do is we want to convert one or the other so that they do end up in the same bucket, and so they ultimately offset and you have permanent tax savings. One way to do that is through real estate professional designation. And this is a very powerful tool. This is a tool that has helped out a lot of people. It is something, a lot of times people are, W-2 employees, and maybe they are W-2 employees, but their significant other does not want to work, or they want to get out of what they're doing, or they aren't doing anything right now, but they are interested in investing. And so if they are interested in investing in real estate, we have this opportunity to take something that would be passive and convert it to ordinary or active income. And so to be a real estate professional, it really comes down to two tests. You have to have more than 750 hours in real estate related activities, and you have to perform more time or have more time in real estate related activities than any other income producing activity. So, and it's aggregated as far as if you're a W-2 earner and your wife is a real estate professional, the losses that she generates in real estate, because she's a professional, are deemed active and ordinary, and they will be able to offset your W-2 income. And so it's not that you have to be a real estate professional. If you're filing joint return, one of you has to be a real estate professional. And this is a huge benefit because this is something that will give you the ability to offset income on an annual basis that would normally be taxed, and in most cases taxed at the highest tax rate. Another opportunity, like we discussed, is captive insurance. And so, this is converting ordinary income to a capital gain or to a dividend taxed at a capital gain rate. And as we talked earlier, this is being able to take an ordinary deduction and shift it over to the captive insurance company that is shifted over in the form of premiums, ultimately tax-free to the captive insurance company. And then ultimately when the owners take that money out down the road, it is taxed at capital gains rate. So we have converted ordinary income to capital gain income, and we've shifted your tax rate from 40% potentially down to 15 and even less. I mean, if you've done effective tax planning in the way the tax code is written today, you can take up to $65,000 a year out in dividends and pay no tax on it. So if you do proactive and effective tax planning, you're in a situation where you've taken a 40% deduction, and down the road, when you're retired or when you're in a position to take money out, you can take that money out tax-free. That's a huge benefit for you. Also, as we talked, conversion from traditional to Roth, because we're taking something that would be taxed at ordinary income rates down the road, and we are converting it to a tax-free investment. And so this is a huge opportunity. It's something that, once again, through proactive tax planning, you have the ability to take something and decide when you want to tax it. And so you don't have to convert all at once. So if you're in a year where you have high income, you don't convert it. But in the next year, you're down in the 15% tax bracket, you look at what it will take to get you up to that next tax bracket, and you convert that amount. And so now you're slowly trickling money into an investment that's tax-free, and you're doing it at a lower tax rate. And the last thing is the idea of converting ordinary income to long-term capital gains. And so a lot of times this is what you see in people that are in real estate, individuals that potentially could be considered developers, is looking at what we can do, how can we change our facts in that business to take some of that ordinary income and convert it to long-term capital gains. Does that mean that we hold the land for a period of time and then we sell that land off to another company and ultimately recognize some capital gains? Is that an opportunity? We just need to make sure that we're structured properly and we look at that. And so a lot of times it's just looking at what we can do either in our operating business, or another perfect example is short-term capital gains. Short-term capital gains are taxed at ordinary income. And so if you hold an asset for a year and a day, it converts from ordinary income to long-term. And so, that's just the idea of being proactive in our planning and saying, okay, I want to hold this asset, but I know I have to hold it for a year and a day. What can I do to situate myself in a position so that I can achieve that and make sure that I'm not paying the highest tax on this gain, and instead I'm paying 15, 20% tax. And so that's, once again, converting from ordinary to long-term. The next is rate reduction. And this is something that a lot of people don't necessarily they look at, but they don't necessarily think about day to day. And one of them is paying your children or paying your parents. A lot of times people have children, and those children, if they have an operating business, or they're investing in a lot of, if they're less investing in multifamily or single family houses, and they're doing day-to-day activities there, and their kids are tagging along. Well, that's fine and dandy, and you have your kids do this. They do filing, they sweep, they clean up the trash, and they get a they get a stipend for that every week. They get an allowance. Well, that allowance is non-deductible to you. It's free money to them. You're paying tax on it, and they're not getting to get the, you're paying tax. They're not paying tax. You're not getting the deduction. It is after tax dollars, and they're utilizing that to pay for things that aren't necessarily life-giving things. So you're not having your kids pay you room and board and food and clothing and things of that nature. They're using it to pay for video games and going out to pizza and seeing movies and things of that nature. Well, why don't we just look at a way and change our facts a little bit and say, okay, well, you know what? I'm going to pay them for that work. I'm going to put them on the payroll. I'm going to give them a reasonable salary for the work they perform, and I'm going to get a deduction for it. And as long as those children are not earning over roughly $6,000 a year, they pay no tax. They have no tax exposure, and you get a deduction. Once again, it is a small amount. It's not dramatic, but 40% of $6,000 is not something that I would overlook if I could do that on an annual basis. And so ultimately, then the children can take this money and they can use it as they want. A better strategy, something that I like to do, is I like to take that money, pay my children for it, have it be a deduction to me, and then throw that right into a Roth IRA. Children, your child's 8, 9, 10 years old. They're helping you clean up leaves. They're helping you clean up around your properties. They're doing things of that nature. They're not going to make, millions of dollars, but hey, they might make $5,000 a year. And if you can take that as a deduction and put that into a Roth IRA, that dollar is going to grow tax-free for the rest of their life. And they can use it for whatever they choose to after a specific period of time. And so they have the ability to take that money out and utilize it for college education, utilize it to buy their first house, or hold on to it and use it for retirement. And so it is a much more flexible, much more valuable asset, in my opinion, than a 529 plan, because a 529 plan has a lot of restrictions to it. And so if you can take this money, put it into a Roth IRA, have it grow tax-free, like I said, your children use it for education. If they don't, the world's changing. People aren't necessarily always going to college anymore. There's a lot of entrepreneurs out there that are making millions of dollars not going to college. And so, who knows where we're going to be 20 years down the road. But if you put $100,000 into a 529 plan and your children don't utilize it, by the time they're 30, they have to take it out and pay a 20% surtax on that. That doesn't necessarily sound like a good idea to me. I'd rather put that into a Roth Roth IRA, have it grow tax-free. If they don't use it for that, then they can use it for retirement. They can use it for anything they want down the road, and it grows tax-free. Another opportunity is the use of entities. So looking at what we can do with entities, looking at splitting our businesses out into different facets or different areas. Are we doing marketing? Are we doing management? Is there a piece of this puzzle that we can pull out and put into a different entity and maybe utilize the tax rates of that entity to take something that would be taxed at 40% and maybe tax it at 15%? And so now we've got something, once again, we're taking that tax arbitrage and we're saving 25% per year. The last one, rate reduction, is timing. Like I talked about before, is there's timing in ordinary and capital gains, but there's timing in income recognition. So ultimately looking at what can we do, what do we have, what's in our toolbox. do we have a lot of passive activity losses? Are we in a situation where we just keep carrying forward passive activity losses every single year? And the only time we get to utilize them is when one of the investments gets sold off. But this just continues. This is a cycle, and we have these losses because we're passive in these investments, and we really don't have the ability to take those. Well, look at timing, looking at what we can do, looking at the investments that we have, available to us. Do we have something that's a passive income generator, or a pig, as we like to call it? And can we put that pig in play and have that income offset by those passive activity losses? So, do we invest in oil and gas? Do we invest in ATMs that are pigs and have those have income flow through to us that's passive income, but it's going to be offset by all these passive activity losses that we have sitting around carrying forward every year, and essentially giving us or generating tax-free income? And so now we've taken something that, might be a 10, 15, 20% return, and we've bumped that up simply because we're not going to pay tax on that income ever, because we've utilized through timing the passive activity losses. So the last one, as I talked about, this is kind of I don't call it an afterthought. We believe that there's so much proactive tax planning and permanent tax benefits in the code that we utilize the first 4, and we ultimately come back to deferral if there is the opportunity to. And so there are opportunities in deferral. One of them definitely is the use of a 1031 or 1045 exchange. 1031 exchange is just, it's an exchange of property, so business property. And a 1045 exchange is a little less known, but a 1045 exchange is the exchange of a certain stock. And so they both are deferrals. They allow you to defer the gain on the sale of an asset for a period of time. Now, there is no finite time period for that, so you can continue to roll that gain over and over and over and over again, as I said, until you pass away, and then your beneficiaries get a step up. But it gives you the ability through planning to defer that tax and recognize it when you want to. And so it's a powerful tool, especially if you're in a tax year where you're in the highest tax bracket, but coming up in the future, you might be in a lower tax bracket and have the opportunity to sell that asset. If you can, then you can effectively pull money out when you want to at a lower tax rate and pay less tax. The other opportunity, like I said, is pre-tax retirement plans. This to me is something that I utilize at, the last step for me. There are opportunities with pre-tax retirement plans, especially if you have a high wage and you're going to have a high wage and you have the opportunity to put it into a SEP 401 or a SEP plan or a SEP 401k plan. You have the potential opportunity to take that deferral and then down the road convert it to a Roth when it's at a lower tax rate. So once again, through effective proactive planning, I can take the deferral today in 40% tax bracket, and as long as it's an IRA and I control that IRA, down the road, let's say 3 years from now, I decide I'm not going to be in, I'm actively investing, my income is growing through passive activities, and I'm going to walk away from my W-2 employment or my operating business, or I'm going to sell my operating business. And I know 2 or 3 years down the road, I'm going to be in a much lower tax bracket. Okay, well, now we can convert that to a Roth IRA. And then that income grows tax-free for the rest of your life. And so there are some opportunities through deferral. It is, for me, it is definitely much more of a planning move, and especially if I know what my future is going to look like and I can forecast out the next 5 to 10 years. It could be a very valuable tool. And so really in conclusion, it has everything to do with being proactive. I say it all the time, being proactive is the best way to be, and making sure that you're talking to your tax advisor, making sure that your tax advisor is talking to you, and making sure that if anything comes up, you pick up the phone and you talk to them and you say, hey, let's let's sit down and talk about this. Let's make sure we structure this right and make sure that we're being proactive before I step into the shoes that I'm about to fill, so I can reduce my taxes as much as possible. And so really, the opportunities are everywhere. You just have to look for them, and it's everywhere. It's not only in your business, it's in investments, it's in vacation travel. It's making sure that you structure yourself in a way that you're always looking for investments. You're always looking to be successful, and you're always taking advantage of the opportunities that are out there to get the tax deductions to drive down that tax bill every year. So to end it, it is really just, change your facts to change your tax. And that's what we really preach is, always making sure to situate yourself through your facts to get the deduction that you need to ultimately drive that tax bill every year.
Well, thanks, Tim. What I'd like to do here is, if you want to, if all you'd like to take a minute and write down your questions in the box, and we'll start reading them off. I have a couple here, some comments, some questions. Myself, this is Buck again. And, a couple things, a number of my listeners are what you call accredited investors, which is meaning that they are, they have, they make either $200,000 a year, have a net worth of $1 million outside of their personal residence, et cetera. There are a few things that are available to them that aren't available to everybody that I thought would be useful to mention and get your comments on.
Sure.
I've utilized oil and gas in the past, which, for me at this point, I'm not a huge fan, but it is a great, you can write off most of your investment the first year. And the other thing that I've utilized over multiple years are conservation easements. And again, these are things that really, for the most part, are available to accredited investors. Could you comment on those a little bit?
Definitely. So oil and gas, from an investment. So this is exclusive on the investment side because oil and gas was a great investment a couple of years ago. It's turning around, but just simply from a tax picture, oil and gas is a great investment because the way that it's structured, it gives you the opportunity to really utilize it as you see fit. And by saying that, I mean, you have the opportunity to either invest in a drilling fund or invest in an income fund. And if you're investing in a drilling fund, as Buck said, you in most cases get to write off a large portion of that investment in the first year through intangible drilling costs. And as long as you are what they call at risk for that investment or a general partner, you have the ability to have that deduction offset your ordinary income. And so if you're investing $500,000 into an oil and gas fund, you might be able to deduct $300,000 in that first year, and that $300,000 is going to offset your ordinary income. And so you could be in a situation where you're dramatically driving down your tax rate through that. Another opportunity with oil and gas through an income fund is what I call, the utilization of a pig. And so, a pig is a passive income generator. And a lot of times what most investors have is they have passive activity losses. They're investing in real estate. They're investing in businesses that have depreciation, have other deductions that are generating these losses that carry forward every single year. And the hardest thing to do is to find a pig. And oil and gas is a great opportunity for that because in an income producing fund, you're in a situation where there are not much, there's not much tax deductions to that. It's a well sitting there pumping out oil. And so your income is passive, it's income, and it can be offset by your pals. So those are both definitely very good from a tax picture, from how you can structure them. A conservation easement in the same way. A conservation easement is a fantastic tax play. As I always say with everything, it's something that you've got to be comfortable and it's something that you've got to want to invest in. And so, if this is something and you're strong on, conserving the environment or conserving history or something of that nature, then this is a fantastic opportunity for you, because what this, this, once again, the tax code is an incentive. It's an incentive for people to give to companies that are conserving the environment, conserving history. And so what they've done is they've said, if you go in and you take this property and you either say you're not going to tear it down or you're never going to build on it, and you put an easement on that property saying it's never going to be destroyed or it's never going to be built upon, we are going to give you a deduction equal to the fair market value of that property. And so you have these companies that will go in, and I'll just stay with the conservation easement. You have companies that will go in and they'll look at and they'll acquire 1,000 acres outside of a metropolitan area. Maybe it's, outside of Myrtle Beach or somewhere of that nature. And they'll look and they'll bring in engineers, they'll bring in architects, they'll bring in everyone, and they'll build the best use for that land, whether it's a master plan community, a hotel, a resort, whatever it is. And then they'll have, that'll be built on paper and they'll have it appraised. And then the appraiser will come in, and ultimately that is the charitable deduction that you get. And so ultimately, let's say you contribute $100,000. In most cases, you're looking at somewhere in the ballpark of, let's just say, a 4 times deduction. So from that $100,000, you're going to get a charitable donation deduction of $400,000. Well, the IRS allows you to take a 50%, so 50% of your adjusted gross income in the form of charitable deductions every single year. And then what you don't use carries forward in the next year. And so ultimately, if you're in a situation where, let's just say your income's $500,000, well, you can invest $50,000 in a conservation easement and potentially get a $250,000 deduction, which will drive your income down from $500,000 to $250,000, which effectively should reduce your taxes by, reduce your tax bill by about 30% on that $250,000. So you're looking at potentially a $75,000 tax savings from a $50,000 investment. Did that answer that for you, Buck?
Absolutely. And, I just wanted to bring those up. They're things that I have personally done. And, people are pretty squeamish about conservation easements because, I've always referred this since you guys introduced me to this, Tim, as the nuclear option, because this can really, really drive down taxes. I mean, literally almost, cut it in, cut it in half in some cases. It's really pretty dramatic. I will send out something, another webinar that was done earlier by my group on this specific concept, but this is a really, really good thing. Oil and gas and conservation easements. And for those of you who are W-2 wage earners and who think you have nothing that you can benefit from, this is absolutely applicable to you as a W-2 wage earner. Captives are really only useful for business owners, and they're expensive. You got to be making a lot of money if they're useful, to be useful for you. I mean, I would say you probably need to make probably $1 million a year for a captive truly to be useful for you. I don't know what your thoughts are on that. Tim, unless you have something else to add, I can start reading off questions here, or if Dave, you have
go ahead.
Okay. Let's see here. So this question here, well, Aaron would love Tim's thoughts on land conservation easements. Well, he just gave that, right? So I got, Aaron, just so you know, by the way, thanks for the bottle of Willet. He gave me a nice bottle for for the holidays for bourbon. Aaron, I got this concept from Provision and Tim. So they are obviously on board with that. And just so you all know, I actually got audited this last year, and it wasn't because of conservation easements. And my conservation easements had no problem at all. I mean, they couldn't do anything. It was totally legal. So, Nathan Shaw, do you have a recommendation on leasing versus buying a car used by a business?
Typically, it just comes down to facts and circumstances, and really what you're doing with that vehicle, how often, how much that is being used, and then ultimately, what's the cost of the two? So it really does break down into the dollars and cents of the transaction, and making sure that you're getting the best investment possible and you're paying the least amount for that investment. So I don't have it should be this or that. It really does come down to analyzing the deals and making sure that it fits in with your business model and it is giving you the highest returns possible.
My friend Phil, who is actually one of my investors in Ambergris Key in the Belize, the Hilton project, asks, what can I reasonably do to claim a family vacation as a deduction? Well, Phil, you actually can deduct that Belize trip, right, Tim?
So you can. It gets a little bit more sticky with international travel simply because of the way that things are. It's more percentage than days of travel. But typically, once again, it's changing your facts to change your tax. So whether it's international or it's domestic, it's just making sure that you have yourself positioned in a way to have that be a business trip. And so when I say business trip, that doesn't mean it has to be for your business. It could be for your investment business. So if you are going to Florida to go to Disney World, and while you're down there, you spend time looking at real estate, talking to realtors, looking at communities, getting an idea and a feel for the market out there, that is going to give you the ability to deduct some of that trip. And so really what it comes down to is just position yourself in a way that you're always looking for investments and opportunities. And if you can do that, then it's not only going to give you the ability to deduct that, but in most cases, it's going to give you opportunity. And so while you are looking to drive your tax down, you're actually finding opportunities that are going to give you returns and make you wealthier. And so, as long as you can just situate yourself in that way and always have in the back of your head that you are utilizing this as a way to invest in a way to grow your portfolio, you're going to be able to deduct that trip and you're going to get wealthier.
Well, and certainly to visit the assets that you currently own.
Too. Exactly.
And that's kind of what I was getting at with Phil in particular, because he's already in Belize, so he could do that one. Let's see. Jason Holtzman says, kids' Roth IRAs. Are you saying kids themselves can make Roth IRA contributions to accounts in their own names, and especially for young ones who are making less than $6,000, could Roth, quote unquote, the funds at a 0% tax?
Yes.
Okay, that's good. Are there limits on how long the funds must remain in the account before a child can use them?
So they have to be what's called, okay, so let's step back a little bit on a Roth, you can contribute to a Roth. Roths have a lot of drawbacks to them. If you make too much money, you can't contribute to it. If you make no money, you can't contribute to it. So, it is limited to the amount of ordinary income up to the cap, which is adjusted for inflation every year. And so, yes, if you have a child that is earning $3,000 a year, they could definitely put that $3,000 into a Roth because their earned income is $3,000. And as long as that Roth is qualified, then they can take the money out. And typically what it takes for a Roth plan to be qualified, it has to be open for 5 years.
Got it. And this Victor Edelman is asking, can you do a 1031 exchange if you sell a property with seller financing over 4 years?
You can. It's just the way you structure the deal. So as long as it's an investment, it's a business property. So it's something that it can't be your principal resident. It can't be a piece of land that you're just holding as an investment. It has to be business property. So if it's a rental property, however the deal is structured, you could do a 1031 exchange. You just wouldn't have, in that situation like you're talking about, in most cases you would do an installment sale because you're getting a piece over the next 4 years. Well, you would just do a 1031 exchange and elect out of doing an installment. And so, yes, you definitely could.
So meaning that you couldn't do it as an installment? I'm confused on that one. How would you do it if you had payments coming over 4 years?
It would just be a 1031 exchange. So it would be, you would report the transaction in the year of sale when the title transfers.
But you have a limited time to actually choose the exchanged asset, though.
Exactly. Yes, you would have to do so. In order to do the 1031 exchange, you would have to identify the properties and then ultimately acquire another property within 180 days. And so if you could, well, now I'm getting a little bit more complicated. You would have to check with an exchanger to make sure that they could hold that escrow fund open for that period of time. Because you could do what's called a reverse exchange, a Starker reverse exchange, where you could actually buy the asset that you want prior to selling the other investment. So you could potentially do a Starker reverse exchange and have the piece of the piece of, whether it's a rental property or whatever it is, and acquire that before you sell the other one. So you could potentially do it that way.
Or you could just give the buyer a loan, right?
You could, yeah, definitely.
Yeah. Okay, Katie Dollinger, can you take depreciation on a vacation home that was passed through a ladybird deed and never reappraised?
You can. So as long as it's a business, it's a business asset and it's a vacation home that you're actively renting, then you can take depreciation. What the depreciable value of that property would be, I'm not sure. It would probably, be the carryover value, especially if it was given to you from a related property or a related party.
Okay, let's see here. I'm sort of losing my spot here, but let me. Can I claim taxes for my remote international workers? It sounds like maybe it's like a internet thing or something. I think basically you're just expensing that, right?
Yeah, exactly.
I mean, so that's how I've done it. If I had a VA overseas, I mean, I don't even count them as employees. I'm just paying, expense. So
it really, to be an expense, it just has to be ordinary and necessary. So if that's something that is, or anything that's ordinary and necessary in the course of business, is deductible. So yeah, I would say that just be an expense.
All right, here, let's see. Jerry, not sure what the question is exactly, but so Jerry is investing in my life settlement fund, and he's asking, a self-directed Roth IRA grow tax-free? Yeah, I mean, I think what he's asking is, will it grow tax? So anything that you make is going to grow tax-free in that IRA, right? So
in a Roth,
unless it's leveraged.
Yeah, exactly.
Hey, can you talk about UBIT taxes? Because you get questions a lot about that. Because when you have an IRA investor who's investing in a property that's leveraged in an IRA, sometimes they have to pay taxes on a portion of that, right? Can you explain how that works? A lot of people ask about that.
So it's called UBIT, and more importantly, when it comes to assets that are financed, it's called debt financed income. And so what the IRS has done is they said, okay, well, any dollar that is earned inside a plan is deferred unless that dollar is earned through the use of other funds. And so a perfect example, if we just make it clean and easy, is you go out and you buy a $100,000 single family house, and you get a $50,000 loan on that single family house, and you make $10,000 a year on that house. Since 50% of the funds that were used to buy that house came from a loan, then 50% of that is considered debt financed income. And so it would be taxable. Now, there are some caveats to it. There's a limitation, as if the income's less than $1,000, you don't have to worry about it. But in simple, plain discussion, if you make $1 and 50 cents of that was, acquired through the use of funds, then 50% of that would be taxable.
Okay. Jerry followed up again. He's saying, is the distribution on it free? Yeah, it's tax free. So Jerry, in terms of the life settlement investment, it's going to be the same. I mean, if you're in a Roth IRA and you made the profits while you're in the Roth, the distribution again is going to be free, right?
Correct.
Tax free. So, Gina Lofton, can you use section expenses for software against ordinary income via a W-2?
Did you say section 179?
She just said section here. I'm assuming she means section 179. Gina, is that what you mean?
I mean, to answer, let's just, okay, assume it's 179. You just have to think, there's a lot more that would have to go into that. So I'd have to have a lot more understanding of what, but if you had W-2 income and you were ultimately, and you had a business that you're buying software through, you could take 179 on it because you have active income through your W-2, even if you didn't have income through that business. Now, whether or not that would be deductible just depends on whether or not the business is active or passive. And so there's a lot of facts that go into that, and a lot of kind of jigsaw pieces that have to fit into that puzzle. But, you know, really with 179, you come down to there's two things that have to happen for it to be deductible. And, you know, the first thing is you have to have active trade or business income. And so if you have a W-2 or you have an operating business and that has income, then you can take a 179 to the extent of, 179 deduction to the extent of that active business income. Now, if the investment is in a passive investment, then ultimately you do get the deduction for 179, but then it could be limited if you don't have passive income because it really is a passive activity, you know, and that goes back to the whole idea of the different buckets. So I don't know if I answered the question. Hopefully I did.
Aaron Kaplan, how young is it reasonable to start hiring kids for work around the house? Is nearly 5-year-old too young to start this Roth concept? I think it's a great question, actually, you know, because I remember reading Tom's book, and he was talking about one of his clients who had her 8 or 9-year-old doing some bookkeeping, right?
Mm-hmm. I mean, it really comes down to what they're doing. And so as they're younger and younger and younger, it becomes harder to find things. You know, you're not going to have a 6-month-old baby making $5,000 a year. But you might have a 6-month-old baby. You know, you see this a lot. Perfect example, dentist offices. You go into a dentist office, I guarantee you, you're going to see a family somewhere. It's going to be on their brochures. It's going to be on their business card. It's going to be on somewhere. And chances are that family is going to be made up of their children. And so what they are doing is they're paying their children for their likeness. And so what you do is, you know, you have a 5-year-old. If you have the ability to utilize them through marketing, you contact a talent agency and say, you know, I need an 8-year-old kid for a day for a photo shoot. And they say, okay, it's going to cost you $400. Okay, well, I don't need that child. I'm just going to use my child. And as long as you're okay using your, you know, employing your children for their likeness, now you've got a fair market value of what that child's worth for a photo shoot, and you pay them $400. And so, you know, when they're younger, there's a lot more bang for the buck in doing that. As they get older and older and older, you can find more and more that they can do. And so, yeah, they can do bookkeeping, they can garden, they can mow lawns, they can do filing, they can do things of that nature. When they're 2 or 3 years old, you know, you might be able to get more money into their hands doing something, utilizing their likeness through marketing.
Wayne asks, is there a cap to convert from a regular IRA to a Roth? I think the answer is no, right? If you have no income, you can convert. It
doesn't. Even if you have income, you can convert. You cannot contribute to a Roth if your income's too high, but you can convert at any time.
Right. By the way, along that lines about the whole concept of the Roth, what are your thoughts? You know, I've been talking a lot on Wealth Formula podcast about, you know, what people call, some people call infinite banking. Some people call it life insurance retirement plan. We call it Wealth Formula banking because we like to call everything Wealth Formula something or another. So your thoughts on that as opposed to a Roth, particularly for, you know, a lot of my group is, you know, 6-figure, mid 6-figure types. what are your feelings on that?
First and foremost, it as long as you can make it work and it's not cost prohibitive, I think it's a fantastic idea. And so, you're ultimately banking on yourself, and you're using the arbitrage from, within the cash surrender value and what you can loan that money out and utilize it for to make a couple more points on what you're doing. So, you're ultimately taking the ability to take this $1 and instead of making 20%, you're making 23 or 24% on it. So I think it's a fantastic opportunity. I think if it's done right, and you analyze the opportunity and you make sure that it's a good opportunity for you, and the break-even points on that opportunity are close enough to the present, then it's a great opportunity.
Yeah. I mean, one of the things I really like about wealth formula banking is the tax deferral for the most part. And then really, as long as you're borrowing your own money and not paying yourself the money, you really never have to pay taxes on it. So that's why I kind of think of it as sort of a Roth on steroids. And then also, you don't have to wait till you're 59 and a half to access it. So that's kind of what I like. So,
yep, definitely.
Let's see. Don Kelly, he wants your thoughts on solo 401k versus Roth IRA, presumably self-directed, I'm guessing.
One's pre-tax, one's post-tax. So, one is going to grow tax-free and one's going to be deferred until you take it out. And so ultimately with the solo 401k, you just have to be aware and understand that down the road you are going to pay tax. And if things continue to go the way they are, you might be in a situation where your tax rate could be, 50, 60, 70%, depending on your investments. So, as long as you're okay knowing that that could potentially happen or come down the pipeline, then, then the 401k is okay. But a Roth IRA is if you can put money into it and pay tax now to get that money into it, you insure yourself that down the road you're not going to pay tax, and that income is going to grow tax-free for the rest of your life. Another thing to remember with pre-tax and post-tax is with a Roth IRA, there's no required minimum distributions. So with the traditional IRA or something of that nature, when you get to 70, roughly 70 years old, they do an actuarial study based on your life, and they require you to take a percentage of that plan out every single year until what they say is your age of death. And so, if you've got $1 million in there and they say you need to take 10% out every year, you have a required minimum distribution of $100,000 every single year that is going to be taxable. With a Roth, there's no required minimum distribution. And on top of that, it passes to your heirs tax-free if you pass away, where a traditional does not. The traditional is what they call income respected decedent, and so it is taxed at ordinary income rates at your death, or shortly thereafter.
Yeah, and this is actually Don. Presuming if you're doing a solo 401k, I'm presuming you may have, you potentially are a business owner or something. And where you can put more money, obviously, into a 401k. But this is one of those situations like we just spoke a second ago. If you want to put more money and you want to have something that looks like a Roth, then considering something like the banking concept that we just mentioned, again, makes a lot of sense, because at that point, the thing that's kind of a downer about the Roth is if you contribute to it and if you have significant income, it's what, $5,000 a year or something like that. It's not a ton.
Correct. You are correct.
So whereas, with the wealth formula banking, I mean, I put $500,000 a year in that. So it's a total different ballgame, right? Let's see. Dave Zook. I know this guy. Let's see. Dave Zook is asking. And Dave, you could ask, you have a microphone there, but Dave's technology issues are another one. But when gifting to your children, how do you determine asset value?
So really, it depends on. So there's two things with gifting and estate taxes. Gifting is done at your carryover basis. So gifting is at your basis, and so what you really want to do is you want to gift. When you're doing a gifting strategy, gifting or estate tax strategy, you really want to look at what do you have a low basis in and what do you have a high basis in, and what's going to appreciate. And so if you're gifting, you want to gift cash. You want to gift things that are not going to appreciate. If you're doing estate planning, you want to take those low basis, potential high appreciating assets and get those into your estate so that they get that step up when you pass away. But really, it's your carryover basis. So if you have, if you bought a property for $100,000 and it's worth $150 now, the value of it is the $100,000. So it carries over to your children.
Jamie Frausto, is there a point where we can take too many deductions, write-offs, and we're hurting our borrowing power? Well, that's yeah, I think that is the case. But what I found, Jamie, and I don't know that this is a tax question necessarily, but what I found is that depending on the sophistication of the bank, I mean, they go back and recreate. If I put a bunch of money into a captive and I've done conservation easements, a lot of times they'll go back and add that back in. Is that fair, Tim?
That is, and to that point a little bit, not so much on the borrowing power, but if you're doing proactive tax planning, you have the opportunity. And I always like to use the bottom tax brackets because there's some deductions that you lose forever. Itemized deductions don't carry over. I mean, charitable does, but your interest, your state taxes, your medical expenses, things of that nature, if you don't use them, they're lost. And so, through proactive tax planning, you have the ability to look and say, okay, can I push this deduction into a future year? Can I utilize all my itemized deductions? Can I utilize the 10% tax bracket? Can I utilize the 15% tax bracket? Because that's cheap money. If I can get money out at 10% tax and I can defer an expense until next year and have that expense ultimately offset a 40% income, then that's what I'm going to do. And so, a lot of times, people talk about, zero tax. But if you do effective tax planning, you're always going to pay a little tax because you're going to want to utilize those lower tax brackets. And like Buck said, with most banks, if they're sophisticated, they're going to go back and they're going to add back the depreciation, the really the non-tax items.
Dave's also has another question from one of his investors and he's asking, are living trusts or LLCs a better method for transfer of wealth? I'm assuming estate planning. I don't think LLCs really have any role for estate planning, do they?
No. I mean, LLCs do definitely, they play into the investment or the holding of the assets, but for estate planning purposes, the use of a trust is the way to go, whether it's a living trust or, an irrevocable trust or, those are the vehicles that get the assets out of your estate into other people's estate.
Hey, I found my mic, guys.
Wow.
All right. So, Tim, I just wanted to clarify on what you said. You remember the conversation a few years ago when I asked you, we were buying multifamily properties, and I asked you, well, how can I get tax-free? How can I get to the point where I'm paying zero tax? And you explained it to me in this way. You said, okay, what we're going to do is we're going to bring your income down to $72,000 or some number around $70,000. And then we're going to stop it there. And any deductions or depreciation that we have above and beyond that, we're going to rule that into next year. Could you explain that and why you did that to capture the itemized, the line item deductions and all that?
Well, it's just that it really is to utilize those lower tax brackets, and like I talked about, in the beginning, depreciation is a really cool tool because it gives you the ability. We can look at something and we can say, hey, I need this deduction now. I'm going to take an immediate, I'm going to deduct it, whether it's through 179 or I'm going to use accelerated depreciation, or I can look at it and say, you know what, I really don't need this. So I'm going to slow it down. And so I'm going to elect to take a slower method. And you're allowed to do that. And so ultimately in your situation, every year as you acquired assets, we definitely that. We want to drive your income down. So I want your taxable income to be at $70,000 a year because that's the 10 and the 15% tax brackets. And so, yes, you're going to pay, ultimately you're probably going to pay $10,000 or $11,000 a year. But, if you're making $1 million and I'm having you pay $12,000 in taxes a year, I'm sure you're not going to be upset with that. And if I can take deductions from this year, postpone them to next year, and ultimately save you 40 cents off of every dollar, because once you get over that $450,000 income level, you're paying tax at 40%. That's what I want to do. It gives you a bigger bang for your buck.
Yep.
Jane asks, can I take advantage of early liquidation of some IRA funds to offset above minimum medical expenses, a way to liquidate IRA funds early?
I don't know if I necessarily understand the whole question, but you do have opportunity to utilize. There are what they call early withdrawal exceptions, and one of them is for the use of funds to medical expenses. So there is that opportunity.
Gina asks, what will people who have high incomes do once tax reform is implemented and SALT deduction removal?
Change your facts.
Can you explain that for everybody, what the SALT deduction removal is and all that?
So ultimately, currently, the way that the Senate, both bills are written, they are getting rid of, they're upping the itemized deduction, the standard deduction. So with individuals, you have the opportunity for itemized deductions or standard deductions. So the IRS says if you have no deductions, we'll give you X immediately. But if you have deductions from mortgage interest, SALT, state and local tax, medical expenses, things of that nature, you can take that if it exceeds the standard deduction. And so they have both bills have ultimately eliminated the state tax deduction, but upped the itemized deduction. And so it is for people on the coast, so people in high tax jurisdictions, whether it's California, New York, this is where it's going to hit them the most. But in most cases, those individuals are also in AMT. And so a lot of times those deductions for state and local taxes are disallowed because they're an alternative minimum tax. The nice thing about the bills that are being discussed right now is they do away with alternative minimum tax. So what is it going to do? I'm not necessarily sure, but in a lot of cases, you weren't receiving benefit from those state and local taxes anyways. So it might effectively be a non-starter for you. It might be something that doesn't affect you at all.
Yeah, what's going on with the mortgage deduction? Do you think that that's going to be? I haven't followed it that closely. Is that limited to 10,000? Do you think that's is that in the bill?
I don't think so. I honestly, once again, everything is about stimulating the economy. And state and local taxes, though they do help the governments, they don't necessarily stimulate the economy, and they're a necessary evil. You have to pay them. And whereas mortgages stimulate the economy, people are buying assets. And so, the Senate didn't drop the limits at all. House was the one that dropped it down to $500,000. I honestly think that's something that will end up being back up at $1 million with the same caps that are in now, because that's something that could potentially stunt growth in that residential market.
No, it would really hurt. I think the residential real estate, a lot of W-2 people are basically buying bigger houses so that they get those deductions.
Yes.
Let's see.
My friend Scott has a question on wealth formula banking. You want to touch on that a little bit?
Sure. What's the question?
Talk more about this banking strategy instead of the IRAs or Roth IRAs.
Well, the best way to learn about it, you can go. We actually have a webinar. You can go to wealthformulabanking.com and you'll see it's wealthformulabanking.com, and there's a webinar there that Chris Miles did, and it's something that I'm really excited about. But effectively, it's they're overfunded insurance policies, right, that pay dividends. Or you can also do it where you have an account in an insurance account that is, say, tied to the S&P 500 in the form of an index fund. But basically, the short of it is that if you can minimize the fees as much as possible, and that's what I've found is I've found a group of folks who will basically strip it down to the legal minimum, which means they're not going to add on any more fees than the insurance company actually pays out. Because normally when you buy life insurance, they tack on a whole bunch extra commissions, and that's what screws up whole life insurance. But when they don't do that, it's very powerful because you can really minimize the amount of fees that you're paying. And usually by year 2, you're sort of at the break-even point where, what you put in or what you can take out in cash value is equal to what you put in. And then the rest of your life, you basically just keep adding to that thing. And it's just a massive Roth IRA on steroids, which you can literally borrow from anytime. And what's cool about even when you borrow from it is that the money continues to grow at this compounding rate. Say it's 5%, 5.5% or whatever. And when you borrow it at a simple rate. So it's a really interesting way of actually creating additional leverage for properties. Say if you're a cash flow investor, you can take something that has a 12% cash on cash and actually, have a compounding element that makes that total return go from 12 the first year. Maybe it turns into 14 or 15 by year 3 or 4, and it keeps going up. Anyway, it's like magic, and it's hard to explain without a lot of images and stuff. So I'd suggest going to wealthformulabanking.com. And there's also a bunch of other cool products that we're going to be talking about, which if you're signed up for this, you'll eventually be able to see more webinars on. So,
Tim, there's a lot of small business owners on the webinar and folks that I'm going to be sending the recording out to in my network. Is there like a one big common thing that most small business owners overlook on the tax side that you see, like that you see most often? It's like, here, you should be doing this, or you should think about something else. What would that be?
The two largest, number one is entity choice. A lot of times people are either sole proprietors, and so they're being taxed 100%, self-employment tax on 100% of their earned income, or they're a partnership and have the same kind of conclusion as far as being taxed 100%. So, the use of entities and the use of tax designation. So utilizing that S corporation when you can to minimize your self-employment tax. The other thing is really not thinking proactively. And so when I say that, and going back to deductions, it really comes down to, what are my deductions? Because a lot of times you talk to people and you get advice from other advisors that say, home office is a red flag, auto expense is a red flag, that's a red flag, you can't go out to dinner that often, you can't do this, you can't do that. And really just making sure that you're capturing every deduction that is afforded to you, and also changing your facts so you can change your tax. And so making sure, hey, I'm going to, me and my wife are in business. And so, I had a business meeting with a potential supplier. Okay, well then instead of going home and talking to your wife, maybe you utilize or you save that until, you save those ideas or you save that information, and you take your wife out. So now you get to enjoy a night out at a restaurant and you talk about business, and now you've got a deductible business expense because you and your wife are in business together. The use of a home office is another one that people don't realize how much, especially in this electronic age, how much they utilize their home for business. And so, just making sure to situate yourself and capture all those expenses from a small business standpoint, those are the two biggest things that I see from people coming to us.
I like how you say change your facts to change your tax. That's actually one of the quotes that changed my life. I mean, I remember hearing that, and for the first time realizing that it was in my control to take care of I could actually take control of my own tax destiny. And when I realized that, I started thinking about, every investment that I'd get into, I would think about, okay, it used to be, I would think about it strictly from a cash on cash return standpoint. But when I started looking at investment and thinking, okay, what does this do to me on the tax side? That's when things started changing, because I viewed my investments and my business differently than I was doing it before.
Yeah.
Well, a lot of times it helps people. I mean, a lot of times people come to us and it's simply an idea that they've never fathomed, but it's an idea also that they've wanted to do for a long time. So a perfect example of that would be, I've got an operating business, but it's really up and running, and it's something that I would like to get away from. I'd like to step away from it in a couple of years, but right now I'm really dug in, and I can't get away from it. So then we start looking at, once again, change your facts to change your tax. What can we do to get you to step away from that? Your ultimate goal is to step away from that. So let's start to position yourself, bring in people, leverage other people's resources to get you away from that investment, to get that investment, that activity to be passive, and then ultimately utilize that passive income to offset other investments that throw off passive losses, such as real estate. So, like I said, it really does come down to always thinking about what you're doing and always trying to proactively structure yourself in a way to be as tax efficient as possible.
We're gonna one thing I just want to add, and again, for the big things, what you can do, I want to make sure W-2 people, if you're accredited this year, the big things, big chunks would be oil and gas and conservation easements for the most part. Outside of that, if you're a W-2 or if you're a business owner, captives, they're a great opportunity. And then, there's all of these intricate things before you know it. Tim's showing you how you chip a few thousand here, a few thousand there. I mean, that's the other part of this, but there are a few ways to do big chunks. Now, I do want to, we have, Dave's got the ATM offer right now, and we've been talking a lot about that because it has the current tranche, Dave, I understand, is a Section 179 offering. Can you tell us, we talked about this a little bit yesterday, Tim, and it's pretty nuanced, but under what circumstance could one of our investors buy a Section 179 ATM machine from Dave, for example, and write it off on this year's taxes?
So in order for that to occur, there's two things that have to happen. You have to have active ordinary income, and you have to have passive income. And so, ultimately you're trying to take that deduction to offset taxable income. And so if you're a W-2 employee, or you own a business, or you have ordinary income, and you also have passive income, so you've got investments that, let's just say, are throwing off $50,000. So you take that 179 expense, let's just say it's $50,000, or let's just use 100 all around for simplicity. So we have $100,000 of passive income, and we have the ATM fund that we paid $100,000 for, and then ultimately we've got W-2 or ordinary business income of $100,000. By having active ordinary business income, it allows us to utilize the 179 deduction, and because we're able to utilize that 179 deduction, and we have passive income, since the ATM investment is passive, that $100,000 179 expense is able to offset the $100,000 of passive income. And so, like I was talking about before, it's buckets, making sure everything's in the right bucket. And your W-2 income is in the ordinary bucket. The ATM investment is in the passive bucket, and then your other investments are in the passive bucket. And so by having ordinary income, it's a stupid nuance with the 179, but by having active ordinary trader business income that includes W-2 income, it frees up the ability to take 179. And since it freed up the ability to take the 179, then you can use it to offset your other passive income. I hope that made sense.
Yeah, that makes sense. Hopefully it does to others too, because this is something that has been, we've been talking about a lot. But effectively, you've got to have, what happens is if you have the active, so you have and do you have to be does it have to be an active business income, or could it be W-2?
It could be W-2.
Okay, so you have to have that income in order to, okay, and then you get Section 179, but you can't write that off against active income, right?
Yeah.
So it basically freezes right there. And then the only way you can actually utilize that 179 deduction is if you happen in the background, say if you had $100,000 of passive business income, you could basically buy that machine and write that off, use that income and write that income off. So if you had $200,000 of income, well, just as an example, 100 from the active, 100 is a passive, and you bought an ATM machine for $100,000, you'd only be paying taxes on $100,000 of income.
Correct. And, one of the nice things about, I always talk about depreciation. I love depreciation because there's so many opportunities, whether it's, 179 bonus depreciation, doing a cost segregation study on a multifamily house or something of that nature. Depreciation is so flexible, and that's one of the nice things about these ATM, about the ATM investment, is because it really, the tax benefits come from the depreciation. So we have the ability, with that type of investment, since it is a depreciable asset, to be able to utilize that to make sense of, to proactively tax plan for your situation or make sense of your situation. So if you're in a position where you have a lot of passive activity losses, maybe we don't need the 179. So maybe we just slow things down and we take depreciation at a reduced rate. And every dollar that comes out of that ATM is tax-free because it's being offset by your passive losses. Or in your circumstance, you have a lot, like you said, a lot of passive income and you have a W-2. Well, great. We'll take 179. We'll offset $100,000 of passive income, and you won't pay tax on it. And so, I mean, that is the beauty of equipment, and the beauty of being able to take depreciation on it is you really kind of can play with it and do what you want.
Well, great. We've been going for about 2 hours here, so Tim, thank you for hanging in there and giving us all this information. And I will send out this as a replay for anybody who wants to take a look at it. And I guess that's about it. Dave, do you have anything else to add before we break here?
Yeah, I got one more thing. Knowing that I have an all-star team, knowing that I have an all-star tax team on my side, I mean, it's quite liberating to think that I can go out and make all the money I want, and I'm not going to pay 20, 30, 40% in tax. And so, I've had quite a few people ask me, what about the new tax laws in 2018? What about this new tax thing that's being talked about in the House and Senate? And my answer is always, I don't really care. All I need to know is that my tax team is on top of it and we know what the rules are so that we can then go ahead and plan according. So I would say thanks, Tim. Thanks for having us tonight. Thanks for the job you've done for me over the last couple of years. And if anybody in the audience is looking for a good tax team, these guys are the best.
Yeah, Provision is best. Tim, can you tell us real quick how to get a hold of you?
So you can give us a call. There's several ways. You can go onto our website, which is provisionwealth.com, and there's a contact us link, and you can fill out information, and we'll give you a call. You can also give us a call at our phone number, our 1-800. So it's 1-866-467-5809, and that's another way to reach us. Or you could send us an email at cs@provisionwealth.com. So that's Charlie Susan at provisionwealth.com.
And as usual, for folks on my list, just you can just shoot me an email at buck@wealthformula.com if you can't remember the stuff, and I'll just forward the email directly to Tim.
Yes, definitely.
All right, guys, great. Thanks again.
Thank you.
Take care.
Thanks, guys.
Bye.